Successful investors carefully plan their portfolio over time. Every portfolio has a structure along with an asset allocation process that follows a specific timing and risk appetite. Research has shown that an optimal portfolio allocates resources to a diverse mix of stocks, bonds, mutual funds, and other securities. Optimally planned portfolios tend to perform better historically than unplanned portfolios, which tend to grow organically in various directions depending on sales and buys over time. In today's program, we give viewers an analytical framework to help them decide how much cash to invest in stocks and bonds. This framework can add some structure to your portfolio and help you provide some clarity to how your portfolio, might be organized and managed. Viewer discretion is advised, as the material indicated in this program is for general information only and, therefore, does not constitute investment advice or financial guidance. By all means, the more prudent course is to seek professional expertise, have a plan, and follow an investment style that fits your goal, risk tolerance, and time horizon. Stay tuned. Hello, hello, hello. Welcome back, folks, to another edition of Sweetie Kiwi. I'm here today, and I'm doing fantastic. I hope you are doing marvelous. If you are, please go grab a cup of coffee or tea or vodka, and let's roll. Today, I want to quickly talk about how much of your money should be in stocks versus bonds. Right now, before we get into the nitty-gritty here, let's just give a quick shout out to our millions of fans and listeners throughout the world, especially Carmen Gill in Huntsville, Alabama, Willow Davidson in Mobile, Alabama, and Lily Griffiths in Tuscaloosa, Alabama. Thank you so much, Lily, Willow, and Carmen, for your support, for your contribution, for your suggestion. We really appreciate that. Now, before we talk about how much of your money should be split into stocks versus bonds, there are key considerations to remember. There are 5 important factors to remember, and those factors will impact how much of your money, your hard-earned cash, you should invest in stocks versus bonds. Now, this is very important because these factors will deeply influence how the money is invested. Your age, that's the first factor. Second factor here, your income, so your financial situation. The third factor, your profession. Fourth factor, your family situation. And number 5, retirement considerations. Let me repeat that. Now, number 1, age, right? So the younger you are, and I will talk about that later on, the younger you are, the more money you can put into volatile securities, aka stocks, right? Because you have time to recover if there is a recession. If the market goes down, you have time to recover. If you are 55 years old or 60 years old and you are a pre-retiree, you don't want to mess around with stocks. You want to go into more quote unquote secure, even though there's not such a thing as security, but you want to go into less volatile vehicles such as bonds, specifically United States T-bills or T-bonds, that kind of stuff, money market accounts, that kind of stuff. So income, right? The more you earn, the more you can invest. So if you earn pretty decent cash, 6 digits salary a year, you can afford to put your cash in more volatile securities, right? Again, something happens, you'll have the opportunity to rebound. Your profession, now, depending on your job, right? Your experience, the industry you're in, the prospects of that industry, all of this will influence your the split versus stock and bond. Your family situation: are you retired? Are you married? Are you single? Do you have kids? Are you the legal guardian for other people? Are you head of household? All this consideration will be important. Number 5, retirement consideration. Right now, the thing here is that, again, we did a great show about retirement, and this is something that you want to check out. We asked the 5 key questions to ask yourself as you're considering retirement, and one thing that's very important is that you got to think about what type of retirement do you envision. Are you thinking about a quiet, just chilling kind of retirement, or are you pondering a more adventurous retirement? Where are you going to live? How would you take care of your healthcare issues? All of those things. So those considerations, among others, will determine whether or not you should put more money or less in stocks versus bonds. All right. I'll be right back right after this. Go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still continuing our conversation around how much money you should be putting in stocks versus bonds when it comes to retirement, but not just retirement. Just as a typical investment process, there are things that you have to think about. Now, number one was key considerations. Number two, proper planning. Before we talk about the stock bond split, you need to plan. And this is very important. If you fail to plan, you are planning to fail. Let me repeat that. If you fail to plan, you are planning to fail. Now, before we get into that, we want to give a shout out to Jude Fraser in Wayne, Nebraska, Sophia Smith in Omaha, of course, Nebraska, and Matilda Bates in Lincoln, Nebraska. Proper planning is important when it comes to determining how much money you should put in stocks versus bonds. You want to determine your financial needs based on your situation. What are your financial needs right now, and what will they be 20, 30, 40 years from now? Seek professional help. I will never overemphasize this. It is important to seek professional help. Now, what do I mean by that? I'm not asking you to actually, break the bank here. You can hire a financial advisor, or if you have the wherewithal for it, if you have the money for it, you can outright talk to your bank and get a wealth manager, an asset manager, or a private banker. Again, we also did a great show around the 12 banks, the 12 types of banks and financial institutions that specialize in helping people become multimillionaires. You might want to check that show also. Great info, great resources there. But bottom line is, you want to seek professional help. Unless you are financially savvy and you know what you're doing, it's worth it paying someone $200 or $300. Sometimes it's even free if you are a client of the bank where the financial advisor is employed. It doesn't hurt to spend some money to get proper advice, right? The third thing you want to do here is that you want to perform periodic portfolio review and asset reallocation. Now, those are two important phrases: portfolio review and asset reallocation. Now, again, if you seek the expertise, or if you enlist the services of a pro, he or she will help you get that. But if you are in that field yourself, you can do it yourself, right? Now, portfolio review just means that periodically, every 3 months, every 6 months, every year, you kind of go through the list of your assets, your holdings, right? Your bonds, your stocks, and sort of determine whether things are working fine, whether it is it makes sense to liquidate some holdings and buy other stuff. This is kind of stuff that you can do now. Nowadays, you have a lot of automation in the market, so you have some robo advisors. So some companies allow you to do that thing, to do this sort of review automatically, so you don't have to do it yourself. Having said that, I still believe that it's important for you to get to know what kind of holdings you have, what kind of assets you have in your portfolio. So it's always good to do it yourself. You can just set yourself a reminder once a quarter or once every 6 months, and just kind of spend 30 minutes or 1 hour or 2 hours and go through your portfolio. So that's for the portfolio review section. There is something called asset reallocation. Now, asset reallocation simply means that you are switching things around. Let's say you have some cash and you feel like you are exposed too much to the IT sector. to the computer sector or to the technology sector, and you want to rebalance things a little bit by spending more money, by buying more shares or having more holdings in the retail sector, this could be an asset reallocation. So asset reallocation can come from a geographic reallocation, if you will, or it could be a security reallocation. For instance, you can sell more stocks to buy more bonds. You can mix things around. We can mix things up with some ETFs. ETF stands for exchange traded funds. You can buy options, bonds. You can. It's the possibilities are limitless as long as you know what you're doing, right? Again, just kind of quick disclaimer here, folks. This show is not about providing investment advice, right? We're not investment professionals, and we do not purport to provide investment advice. This is a general information show. Your personal situation is different, which is why I always insist you want to seek the expertise of a pro, or do it yourself if you know what you're doing, right? Now, another aspect of proper planning is that if you do it right, you can gain financial peace of mind with proper insurance coverage. Insurance coverage is very important. I know this show is about stocks versus bonds, but when it comes to financial planning, when it comes to long-term financial planning, you cannot avoid insurance, because insurance is a risk mitigant. Insurance allows you to mitigate risk, to prevent risk, to manage them. So when it comes to insurance, there are a few insurance policies you want to think about: professional liability, health insurance, life insurance, home insurance, and something called supplemental accident and health insurance. This insurance portion should be part of your planning before you even think about whether or not you should put some money in stocks versus bonds, right? What I'm trying to say here is that you need to have some kind of insurance coverage before allocating more of your cash to something else, including stocks and bonds. All right, I'll be right back right after this. Welcome back, folks, to another edition of Sweetie Kiwi. We're still having a conversation about how much of your cash should be in stocks versus bonds. If you just catching this show as we go along, please remember that today's conversation is very important, because successful investors carefully plan their portfolio over time. Now, remember that every portfolio has a structure along with an asset allocation process that follows a specific timing and risk appetite. Now, the stock bond split. There are 5 categories, and I want you to take a look at the image we have on the screen here. You have conservative, moderately aggressive, and very aggressive. Again, please take a look at the screen right now so you understand what I'm talking about here. Now, when it comes to a portfolio, we have low risk or high risk. Now, of course, this depends on your personal risk profile. If you are conservative when it comes to risk, in other words, you are risk averse, that means that you are espousing a low risk approach. If you are a risk taker, that means you are very aggressive. You are espousing a high risk approach, and the rest is in the middle. Now, conservative, it means 50-50. It means you are allocating 50% of your cash to stocks and 50% of your cash to bonds. Now, if you're concerned with preserving your capital, then achieving higher returns, then invest half of your money in stocks. The good thing here is that you can basically, you have a cushion, right? If the markets were to fall, if we are in a down market, your portfolio wouldn't fall that much because you are able to diversify. Now, if you want to avoid risk entirely, then I would say don't invest in stocks or bonds, because even bonds will actually go lower, although less lower, if that makes sense from a grammatical point of view. But the thing is that bonds tend to fall not in the same way as a stock. So you might want to go with safer investments. I'm talking here money markets, CDs, if you want to avoid risk entirely, and some types of bonds, right? I'm talking US government bonds, T-bills, T-bonds, right? And you want to avoid stocks altogether. So zero risk means zero stock. 100% money market account, or money market vehicles, money market securities, CDs, and bonds, certificate of deposits. If you are a moderately conservative kind of investor, then you want to put 60% of your cash into stocks and 40% of your cash into bonds. All right. Now, with this allocation, if you have a little drop in the market, your portfolio will drop in value, but not that much. It is important, however, to rebalance this type of allocation once a year, because anything can happen again. And you have to think about the factors I spoke about earlier: your age, your income, your profession, your family situation, and your retirement considerations. Those things will impact the sort of rebalancing you do at the end of the year. The third scenario here is moderately aggressive. This is 70. Here we have a 70 to 30 split. So 30% in bonds, 70% in stocks. Now, this is pretty good if you're young. If you're in your 20s and early 30s, you can basically be moderately aggressive here, because if the market if we were to have a downturn, what specialists call a market correction, you will have time to recoup. You'll have time to recover. Now, of course, if there is with this allocation, if the market goes down, you will see somewhere between 10 to 20% drop in value. Now, it is important when it comes to reallocation to review this portfolio and rebalance things around about once a year. The fourth scenario here, aggressive, what we call aggressive. Please take a look at the arrow I have on the screen for you, so you can see what I'm talking about here. You can see that when we talk about aggressive, we are tilting towards high risk, right? So aggressive, the split here is 80-20. So 80% of your cash goes into stocks and 20% goes into fixed income products, aka bonds, right? So with this approach, this is aggressive, as the name implies, right? This is, research has shown that you can do this if you are wealthy or young, because this is pretty high. It's a very high risk. Things can happen. The market goes up and down, and if something were to happen, you have time to basically recover. Now, with this type of setup here, you want to rebalance this allocation about twice a year, so every 6 months. Now, I'm not a big fan of reviewing your portfolio all the time, but you want to make sure, because you are invested so much in a single type of security, aka stocks here, you want to make sure that you are looking at the market and seeing where things are going with your portfolio, because the last thing you want is to lose everything where a crisis to happen. And the last scenario here is very aggressive. This is where we are talking about the high risk area, and this is something that, again, investors or specialists will recommend to people who are young, making tons of money, or comfortable financially. Very aggressive. This is here we have a 90-10 split or a 100-0 split. In other words, you are investing 90% or more of your cash into equities, into stocks. Now, this is pretty good if your goal is to achieve double digits returns. If your goal is to achieve an ROI that is higher than 10%, you should allocate 100% of your portfolio to stocks. Now, the thing here is that there is a risk, right? The risk here is if the market drops, you could see a significant drop in your portfolio. When it comes to this, historically, the stock market has always performed pretty well, and it is safe to assume that as long as you can ride the lows, you'll be pretty much set to ride the highs, right? If you can really stomach the lows, then you're pretty fine. So this is pretty much it. You have 5 scenarios: conservative, moderately aggressive, and very aggressive. We'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. If you just joined us or you've been listening to us for a while now and you appreciate the content of the quality of our content, please consider subscribing to our channel. Share this, comment below, turn on the notification bell so you are made aware when we release new shows. We do this every single day, and this is something that we love doing, and thank you for your support. We appreciate it. Now, let's talk now about the ideal portfolio mix. What companies or what specialists call optimal portfolio. Before we talk about that, let's quickly give a shout out to Chris Andrews in Honolulu, Hawaii, Olivia Poole, Honolulu, Hawaii, and Heidi Can in Kalua Kona, Hawaii. Heidi Can, Olivia Poole, Chris Andrews, we love you all the way from Hawaii. Thank you so much. Now, I was talking about ideal portfolio mix. This is an important conversation to have when you talk about how much you should invest in stocks versus bonds, right? Now, the thing here is that the ideal portfolio is what investors call optimal portfolio. Now, you have there's huge research going on around that. Has been going on for years. There is something called the MPT, the modern portfolio theory. That this is a theory that provides a systematic mathematical approach that maximizes a portfolio expected return for a given amount of portfolio risk by selecting the proportion of various assets. We're putting on the screen right now a graph, and if you want to take a look at that, it kind of talks to you about how you can maximize portfolio risk and return. I don't want to dwell too much on theory here because this things can be very, very technical. If you don't have an MBA or a PhD in economics, you might be lost here, but we'll just go straight to the point here. So when it comes to optimizing your portfolio, there are two variables. You have the return and the risk. As you can, the risk here being the standard deviation, and as you can see on the graph, the performance of your portfolio is a product or a byproduct, if you will, of return and risk. Okay, now optimizing your portfolio can be done using normal distribution. This is again another technical term here. I'm not going to dwell on that, but the thing is that normal distribution, quickly, that's just the probability distribution that plots all of its values in a symmetrical fashion. All right, we'll have if you want us to have to commit an entire show to the normal distribution and expected return in the investment context, please comment below, let us know, and we'll do an entire show on this very interesting topic. Okay, now the thing here is that if you want to maximize your return and risk, you have to remember that the goal here is to allocate your assets in a systematic way that is in sync with your risk profile, right? For instance, if you look at the file that we have here, the graph that we have here, you would see that various assets generate various risk profile, right? If you go with large cap stocks, for instance, which are shares issued by companies that have a market cap of $10 billion or more, those large cap stocks are low risk, right? I'm talking about the IBM, the Google, the Facebook, the Walmart of the world. Those companies are large cap. They've been around for years. They probably will be around after you and I die. I mean, who knows, right? But the thing is that if you look at the risk profile from large cap to all the way to money market, you are basically having a pretty low risk securities. Now, if you want to switch things around, if you move on to small cap stocks or international securities, those are stocks from emerging markets. Those might be higher risk. They might invite a higher risk because of their nature. Now, higher risk means high potential return, right? Low risk means low potential return. So this is basically how you want to think about those things. All right. Now, another thing I want to say here is that also you can also invest in money market securities. Now, those are investment in short-term debt, typically a year or less, right? Treasury bills, I mentioned this before, T-bills. Now, those are what investors call money market investments, and those are pretty safe. All right, those are pretty safe. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still here. We are about to wrap up today's show. Want to quickly give a shout out to Bailey Pearson in Fayetteville, Georgia, Jasmine Hudson in Johns Creek, Georgia, and Caitlin McCarthy in Decatur, Georgia. Thank you so much for your support, for your suggestions, for your feedback. We really appreciate it. Let's just kind of quickly recap today's conversation. Before I recap it, let's just say, what was today's conversation? Conversation was about how much of your money should be in stocks versus bonds. Successful investors carefully plan their portfolio over time. Every portfolio has a structure along with an asset allocation process that follows a specific timing and risk appetite. Research has shown that an optimal portfolio allocates resources to a diverse mix of stocks, bonds, mutual funds, and other securities. Now, optimally planned portfolios tend to perform better historically than unplanned portfolios, which tend to grow organically in various directions depending on sales and buys over time. Now, in today's program, I have given you an analytical framework to help you decide how much cash to invest in stocks and bonds. This framework can add some structure to your portfolio and help provide some clarity to how your portfolio might be organized and managed. Now, as I said before, viewer discretion is advised, right? Because the material indicated in this program is for general information only and therefore does not constitute investment advice or financial guidance. By all means, the more prudent course is to seek professional expertise, have a plan, and follow an investment style that fits your goals, risk tolerance, and time horizon. So today's show, I talked to you about the key considerations to have. Proper planning. I gave you 5 scenarios when it comes to stock bond split, right? And the ideal portfolio mix. Okay, now I have a call to action here. Actually, it's a series of things I want you to do today because it's always important to have the info, right? But you got to act. You have to do something. Now, here are some suggestions on how to attain an optimal portfolio. Hold only a few positions in your portfolio, and please don't let the total exceed 7, 8, 10% maximum of your portfolio. You want to always own a strong dividend paying company in every market sector. If you have technology, you want to have a strong dividend paying company there. If you own, retail, you want to, I don't want to advertise for any company here, but it's pretty easy to just Google it. You'll find for every sector companies that are strong financially and that pay dividends, right? You want to also maintain a long-term time horizon. It's very important, which is why I want you to move far away from volatile assets and closer to safer, less volatile assets, all right? Don't trade, invest. This is very important. Investing takes a long-term vision. Trade is more short-term. Nothing wrong with it, but if your goal is to have a long-term vision, it's better to invest. You want to also cap every single position at 5% of your portfolio, which is very important. It's all about risk management, right? You don't want to put all your eggs in the same basket, in one basket. Don't let short-term anxiety, or market volatility derail your investment plan. If you have a long-term vision, don't let yourself distracted by the short-term yo-yos of the market. Market always goes through yo-yos and has been doing so for the last 200 years before you and I were born. All right, so this will continue to happen. This is a mixture of human behavior and economic behaviors. So this is nothing you can do about it. Don't worry about it. And the thing here is that don't take on more risk than necessary to meet your goals. In other words, you want to know your risk tolerance, your risk profile. Okay, this is about it, folks. And I will see. Oh yeah, I have a pro tip for you, and I'll say this right after this. Don't go anywhere. Here is today's pro tip. Keep some dry powder, that's cash, to take advantage of panic corrections that go too far, taking all sectors and asset classes down at the same time. As I said earlier, the market goes through ups and downs. So you want to keep some cash on hand. So then when that happens and you see a good company that's just having temporary financial difficulty by having its stock smashed, it's time to buy. Thank you, and remember to stay marvelous.